Once again, I welcome you in the another session of accountancy. Today we are going to study about the various accounting concepts or assumptions and its related principles. Okay? So it is necessary to know about the various concepts and its principles. So that we are going to study today. The first concept is all about going concern concept. Going concern concept. This concept says that once the business started, it cannot be stopped at any cost. Our intention is to move forward. You're getting a point? It must go on. The activity of business must go on. It cannot be stopped in between. Once the thing started, it has to be continued. It cannot be stopped. So that is called going concern concept. Second is consistency assumption. This assumption says that once the things are decided, it cannot be changed in between. Once the system decided, once the method decided, it has to be followed throughout the year. It cannot be changed frequently. You're getting the point? It cannot be changed throughout the year. This is called consistency assumption. Once the thing decided, that has to be followed. The third one is accrual assumption. This assumption says that we have to consider the happening date. Happening date means when the transaction takes place, when the transaction is completed. For example, goods sold on 10th March and its payment received on 5th April. Okay? Sold on 10th March and its payment received on 15th April. So, the sale transaction done on which date? 10th March. So we have to consider 10th March. Okay? So this is called accrual assumption. Accrual assumption means happening date. The transaction happening date or period has to be considered, or transaction happening date has to be considered. So these are the various accounting concepts or assumption. Then come to the next topic, that is accounting principles. The first principle says that accounting entity. Accounting entity means we have to record the entries in the accounting book according to the business point of view. According to the business point of view, it means we have to treat business and owner as a separate, because business is existed as we existed. We are identified by our name. Similarly, business also identified by its name. So we have to treat these two as a separate. So both identity should be there. This is called entity. So while making entry, what we have to do? We have to pass entry according to the business angle. Okay? Business should exist in the world. You getting point? For whom the account we are preparing, it should exist in the world. That is called entity in another sense. Next is money measurement principle. Every transaction has to be measured in terms of money. For example, purchased goods from Ravi rupees 10,000. Here 10,000 is measurement of that particular transaction. So similarly, every transaction is measured in terms of money. Okay? Paid salary rupees 20,000. It means 20,000 is the money measurement of that particular transaction. So every transaction has to be measured in terms of money. Next is accounting period principle. Accounting period principle says that accounting has to be done for a period, say 1 year. You getting point? Once in a year, after preparing, after posting each and everything, once in a year, the businessman is the businessman must be eager to know the result of his or her business, whether the business is moving towards profit or loss. For that reason only, what we have to do, we have to prepare the final statement at the end of the year. And this has to be prepared once in a year. Okay? So, it is clear that accounting period has to be followed 1 year. So, we have to treat everything, we have to treat every entry of that particular year, and at last we have to assess it in order to know the actual profit or loss. So that is called accounting period principles. Accounting period principle says that accounting has to be done for a period that is 1 year. Next, full disclosure principle says that everything has to be disclosed in its full manner, without hiding anything, without leaving anything. Then only proper accounting can be done. If you want to prepare a proper account, what we have to do, we have to disclose every accounting information in complete, without leaving or without hiding. This is all about full disclosure principle says. Then materiality principle says that whatever the things recorded in the accounting, that should be believable. That should be believable. For example, our turnover is 1.5 lakhs and we are showing expenses, repairing expense of 2.5 lakhs. So this is not a justable here. You're getting a point? This is not at all believable, because our total turnover is only 1.5 lakhs. How we can spend 2.5 lakhs on one item as a repairing? So here the things are not believable. So that's why this material principle says that whatever the things are recorded, accounting informations are recorded, that should be believable. Next, historical cost principle says that to be recorded at the price paid to acquire, not market value. Okay? So historical cost says that whatever the reduced value or the value of that period, okay, has to be considered, not to the market value. Okay? We have to record only the price on which it was acquired. The price on which it was acquired. We have to treat the price, or we have to record the price on which it was acquired. Okay? We are not supposed to consider the market value at that related time slot. Okay? So this is all about historical cost principle. We have to consider only price paid at the time of acquiring the asset. Whatever the price paid at the time of acquiring an asset, that has to be considered. Okay? Not market value. Next is matching concept. Matching concept says that every revenue is matched with its expenses in order to trace out the result. It means we are going to subtract the expenses from the revenue in order to get the result, in order to get the profit or loss. So this can be only ascertained when these two heads are matched together. Okay, that is called matching concepts. Okay. Next is dual concepts. Dual concept says that double entry system. We are following double entry system, so every transaction is going to have double effect, twofold effect, and we have to consider those effect in the accounting system. That is called dual concepts. Next is revenue recognition concept. It says that just now I told you what in accrual assumption Okay, dealing date has to be considered. Sold goods on 10th March, but payment received on 10th April, for example. Sold goods on 10th March and its payment is going to receive on 10th April. So we have to consider which date? 10th March, because sales dealing is completed in this sale dealing took place in this date, 10th March. Okay. Similarly, for example, we received advance from a party on 10th March, but the sale is going to take place in 5th April. So here sale is going to take place on 5th April, but we received advance on what date? 10th March. So we have to consider 10th March, right? So that is all about revenue recognition concept. Revenue recognition concept. Okay, we have to consider the happening date. When the dealing is happened, we have to consider that date. Next, verifiable objectives. Verifiable objectives says that as we are passing transaction in the accounting book, we should keep one proof, one evidence in the form of document. For example, bill, for example, cash memo, which verifies the transaction, that kind of transaction took place on a particular date, on particular time, and the concerned officer signed, or the concerned officer authorized to pay the amount, or is authorized to receive the money. You getting point? So verifiable concept says that every transaction must have a proof, evidence, okay, in the form of document such as bill, cash memo, etc. Okay, so I hope you understood this topic. See you in next episode. Please do subscribe and press bell icon.